Welcome to another video in my series on Forex trading for beginners. In this video, I'll go over lot sizing, how it works, how you use it in your trading, and I'll also cover other related topics like how to pick a broker based on lot sizes and first in, first out. All right, I think the best place to start is to understand why lot sizing is important and why you need to understand this stuff. And I realize that people learn basically in two different ways when it comes to trading. Some people like to see the numbers and see how that works. And then other people like to see the theories in action, and I'll actually execute some trades in a demo account to show you these principles in real life. And be sure to stick around to the end because I'll also talk about brokers and how to choose your broker based on the type of lot sizes that they provide. And that's really important also. So an important thing to understand in trading is that there is basically a hierarchy of factors that are important in successful trading. So the first factor is going to be your trading psychology. The next factor is going to be your risk management. And then the third factor is going to be your trading system. And a lot of beginners get that wrong. They try to put the trading system first and the psychology last. And that's why a lot of traders don't succeed. So if you put your psychology first and then your risk management next, you'll be in really good shape. And sometimes, the trading system doesn't matter all that much if you have those two things squared away. So lot sizes are all about risk management. How are you going to manage your risk? How much are you risking? And basically, how much are you making or losing per trade? So I think a lot of people understand stock trading. So I'll start from there because it's a little bit of an easier example. And then I'll get into Forex and how the same principles apply. All right, so here's a simple stock trading example. And stick with me because these principles are easier to understand and they will translate better over to Forex. All right, so when you're trading stocks, you could buy one share of stock, right? So let's say you bought a share of stock at $100. Now let's say a few days went by and that share of stock went from $100 to $120. So you just made 20 bucks minus the commission, right? So that's just one share. Now let's say that you bought 100 shares. Okay, so that same move from 100 to 120 with 100 shares of stock would have netted you $2,000 minus commission. So as you can see, the position sizing or the lot size makes a difference as to how much money you're going to make. It's going to multiply your profit or your loss. And just be aware that also you could have lost $20, right? Or you could have lost $2,000. So you want to make sure that your lot size is dialed in so that you're risking the appropriate amount for your account size. So if you think about lot sizing in Forex, it's similar to the number of shares of stock that you're buying. So before we go any further with this idea of number of shares of stock or number of lots in Forex, let's talk about pips. Some people don't understand what pips are, so I'm going to go into that really quickly. Okay, so your basic currency pair has two currencies in it, right? You're going to have the base currency, which is the first one, and then you're going to have the quote currency, which is the second one. And all that really means is that you're basically asking the question, okay, if I traded €1, which is the base currency in this Euro USD pair, how many US dollars would that equal? So in this example, you can see that €1 equals 1.18152 US dollars. All right, now that you understand what a currency quote is telling you, let's take a look at how to calculate pips. And this is another topic that some people are confused by, so I want to go over it really quick. Just a quick reminder before we get back to the video. If this video was helpful, a thumbs up is always greatly appreciated. If you have a question or a comment, leave it in the comment section below. If you want to get updated on new videos, subscribe and hit the bell so you get notifications. But the best way to support this channel is to go over to our archive, take a look at the videos, find the ones that are useful to you, and forward them to people who you think might find them useful also. All right, back to the video. So in Forex, there are basically two types of quotes when it comes to commonly traded pairs. One type of quote is currency pairs that have the Japanese yen in them, and the other type is the ones that don't have Japanese yen in it. So Japanese yen pairs are a little bit different. They're quoted in two to three decimal places. So let's take a look at these quotes and how to calculate pips from them, because we need to know the pips in order to calculate our profit and loss, as well as our risk per trade and how many lots we're going to put on when we take a trade. Let's start with the first one, the standard British pound US dollar. This is how most Forex pairs are quoted, the ones that don't have Japanese yen in them. And for example, you could have a quote like one spot 96565. And a broker can quote this in two different ways. Number one, they could give you just one spot 9656, 4 decimal places, and that's quoted in full pips. So the fourth decimal place is the full pips. However, in the stock market, some brokers will also quote in fractions of a cent. So you'll have $100.50 and maybe 1/10 of a cent. So spot 501, right? So this is very similar. So some brokers will quote currency pairs in fractions of a pip, or they're also called pipettes. When you see 5 decimal places, you know that the 5th decimal place is the pipette, or the fraction of a pip. It's like a fraction of a penny in the stock market. All right, so let's say you put on a trade and you went short British pound US dollar at one spot 96565. You woke up the next morning, the price was now one spot 95564. So you would subtract the two numbers and you would get 100.1 pips. And that would be your profit. Now let's go over to the Japanese yen pairs. These are quoted a little bit differently. There are 2 decimal places if the broker is quoting in full pips, and 3 decimal places if they're using fractions of a pip. So for example, let's say you put on a short trade on the pound yen and you went short at 148.826, and then again you woke up the next morning and the quote was 147.825. That would also be 100.1 pips of profit. Because the Japanese yen pairs are quoted a little bit differently, it's going to look a little bit different, but the result is the same. All right, now that you understand the basics of how Forex is quoted and how to calculate profit and loss in pips, let's take a look at lot sizes. Now, these are the lot sizes that brokers typically offer. Some brokers will only offer the bigger lot sizes, some will offer smaller lot sizes. So you really have to understand what the broker offers and how much money you have to trade, and choose your broker accordingly. So the first type is called the standard lot, and that's 100,000 currency units. So basically you're controlling 100,000 currency units. And you could think of that sort of like in the stock market if you had 100,000 shares, right? It's a kind of a similar concept. So in practical terms, when you're on your trading platform like MetaTrader 5, a lot of times they'll ask you to enter your lot size as a number. So in this case, a standard lot will be 1. You just put a 1 in there and the platform will know to execute a trade with a lot size of 100,000 currency units. And I'll show you this in practical terms in the MetaTrader app in a bit, but I just want to get this theory out of the way. All right, so the final thing to understand with a standard lot is that you're going to be making or losing $10 for every pip. All right, the next lot size is the mini lot. That's 10,000 currency units. In your platform, you're going to enter that as 0.1. And that's going to give you a profit and loss of $1 per pip. Next comes a micro lot. That's 1,000 currency units. You would enter that as 0.01 on your trading platform. And that is going to make or lose 10 cents a pip. And then finally, there's the nano lot. Not a lot of brokers offer this because they don't make a whole lot of money with the nano lot, but a nano lot is 1 currency unit, and you're going to make or lose $0.0001. So you're probably wondering, why would I ever want to do that? That's such a small amount of money. And nobody's actually going to trade 1 nano lot. But the cool thing here is that you can tailor your lot size with a nano lot regardless of what account size you have. So let's say you have a $1,000 account and you only want to risk 1%. So on a $1,000 account, that would be $10. Now with a standard lot, you can only set your stop loss at 1 pip, right? Because that's going to lose $10. However, with a nano lot, you have much more flexibility, and you can probably put on almost any trade with a $1,000 account. Whereas if your broker only allows standard lot sizes, then you're going to be in big trouble. All right, now let's see how this works in real world application. So I'm going to have the MetaTrader 5 app open here, and I'm going to execute some trades at these lot sizes. So a few things to keep in mind here. Number one, there's a spread when you trade Forex. So there's a difference between the buy and the sell, and that's how the brokers make their money. So in the stock market, brokers charge a commission. Some brokers charge like $7 a turn. But in this Forex market, they're charging a spread. So you're going to be down a little bit, but that's simply just like the commission that the Forex brokers charge. So it's important to keep an eye out on the spread, and that will tell you how much you're going to be down when you're entering a trade. And this will show how lot size affects risk or dollars per pip. All right, I'm going to use the Euro US dollar in this example, but remember that currency pairs have different pip values. So 1 pip in the Euro US dollar is not going to equal 1 pip in, say, the Euro pound. And you can look that up on your broker's website. But the same principle applies to those other currency pairs. All right, let's take a look at trading the Euro US dollar. And this is a demo account. So I'm going to scroll down there and take a look at the spread. So right now it's a 0.3 pip spread. So almost a third of a pip. So it's not a full pip. So this is a really good price. So let's take a look at a trade. In this trade, I'm going to enter a 0.01 lot size. And if you will remember from the table, that's a micro lot. All right, so as you can see, now I'm down 3 cents. And that makes sense because a micro lot is 10 cents per pip. And since the spread is 0.3 pips, it's almost a third of a full pip. And since a full pip would have been 10 cents loss here, it's at 3 cents. So that makes sense, right? All right, now let's go forward and do a 0.1 lot size. And I'm going to buy. All right, and as you can see, now I'm down 30 cents. And that makes sense also because you're just adding a decimal place, basically. And that is a mini lot. Now let's do a full standard lot. And now I'm down $3 because I'm just moving the decimal place over again for a standard lot. Now let's see what happens if I trade 10 standard lots. All right, and again, the decimal place just gets moved over. All right, now that you've seen these lot sizes entered into the MetaTrader 5 platform, let's take a look at risk calculation. And this is the important thing. How much are you going to risk and what lot size do you have to enter in order to achieve that amount of risk? So let's say that you have a $10,000 account and you only want to risk 1% per trade. So on any given trade, you're going to only risk $100. So let's also say that you have a 100 pip stop loss on a trade. So what you're going to do is you're going to divide the dollar amount that you want to risk divided by the number of pips of risk. In this case, it comes out pretty simple, and that's $1 per pip. So in order to achieve $1 a pip lot size, you're going to enter one mini lot, which is 10,000 currency units, as you remember from the table that I gave you. So obviously, this is a clumsy calculation if you have to do this for every single trade. So there are trading calculators out there that will calculate your lot size. And I suggest you use them in the beginning so you understand how this works. And you should use the one that your broker provides because that's going to give you an accurate cost per pip for the different currency pairs out there. So an even easier way to do this is if this is already baked into the trading platform that you're using. And that's one of the reasons why I like TradingView. If you haven't seen my review on TradingView, you can take a look at it in this link here, or I'll provide it in the description. And TradingView automatically calculates your lot size based on the amount of risk that you're taking and the amount of pips that's in your stop loss. So if you look at this demo account here, if I wanted to buy, incidentally, it also shows you the spread right there. So it's really nice. You don't have to calculate it in your head. But let's say that you have a stop loss of 20 pips here, and you only wanted to risk 1%. And this is in nano lots. So you would put on 2,065 nano lots for this trade, which brings me to an important point here. If you have a small account, you're not going to be able to trade some of the bigger lot sizes like the standard lot or the mini lot, obviously. So if you have a small account like $1,000, $500 or whatever, you should be in a nano lot account because that's going to give you the flexibility to take these 1% trades, 2% trades, and still use the right amount of risk. Whereas if you used a broker that didn't provide those smaller lot sizes, then you're going to be in trouble because your minimum risk is still going to be very high. So on this trade, if my broker didn't provide nano lots, I would either have to go down to 2,000 units, which is 2 micro lots, or I'd have to go up to 3 micro lots, which is way more risk than I want to take on this trade. So when you're choosing a broker, you should take a look at the minimum lot sizes that they offer And based on the amount of money you're going to trade, you should choose your broker accordingly. If you want to see the brokers that we recommend for these various lot sizes, you can go to tradingheroes.com and look at our resources page. Another topic that you should know about when entering trades is first in, first out, and hedging. Now, in US accounts, you cannot hedge, and you have to abide, or the brokers abide by first in, first out. So the first trade that you enter has to be the first one that you exit. So for example, maybe you did 2 trades on the Euro US dollar. One was for 1 mini lot and the second one was for 2 mini lots. But you can't exit the 2 mini lot one until you exit the 1 mini lot one first. And that's how they want to do it. It doesn't make too much sense to me, but that's the rules. But in most other parts of the world, these rules do not apply, so you don't have to worry about it. Now, first in, first out, or FIFO, and hedging does not affect all traders in the US. Some traders, they could care less because their trading style does not require breaking those types of guidelines. So if you are somebody who needs hedging and first in, first out, or want to get around first in, first out, and you have a US account, then watch my video on getting around that. There are ways that you can kind of get around it. You can't totally get around it, but there are things you can do to have similar functionality, even if you have a US-based account. All right, stay tuned for the links to the useful trading videos coming up next. And that's everything you need to know about Forex lot sizing. If I missed anything, leave a comment below, and thanks for watching.